Where we're seeing opportunity, within bonds, you've got duration, but you've also got credit. And credit spreads were extremely wide last year, giving a great entry point to buy credit, both in the US and Australia. Today, that credit spread's really contracted in the US, but stayed relatively wide in Australia. So if you look here in that sort of green section, you've got US investment grade credits, and you've got Australian investment grade credit. You can see the Aussie investment grade credit is giving you a higher yield, total Australian dollar hedged yield, than US, despite being a credit notch higher. It's higher quality and has a higher spread inside it. In fact, the spread is actually compensating you for a recession. So if we're wrong and there's a recession, at least you're getting paid for it there, whereas in the US, you're actually getting very little compensation. And we like other asset classes like Australian higher yielding credit. That's not sub-investment grade. That's your triple B plus corporates. That's your sub-debts and tier twos and banks. That's giving you a pretty healthy yield for the higher quality. So it is about 1.5% less than global high yield, but global high yield credit rating is still a single B, whereas we're talking about triple B corporates. So you're getting paid a pretty nice spread, and most of those are sort of floating rates. So if you think that that rates can back up again, you want to be sort of in that sort of Australian higher yielding asset class. So we do like that. Within the US, we like securitized credits, because similarly it's giving you a more attractive spread than corporate credit. Mortgage-backed securities, which are backed by the government, AAA rated, they're trading at a higher spread than corporate bonds, which are lower rated and not backed by the government. And finally, I guess in the more exotic asset classes in bonds, we do like insurance-linked securities still. That's giving you around 12% yield once you hedge it back to Aussie and take out expected loss, but zero correlation to equities and bonds. And within Australia, finding private debt is the only way to access true sub-investment grade opportunities here. And that's giving around 10% in Aussie dollar terms. And again, that's floating rate. So long story short, neutral on overall duration, becoming more negative on global credits, but preferring Aussie credit quite a lot due to valuations, and finding more, I guess, niche asset classes like securitized credit, private debt, and ILS to get those returns in the portfolio and those yields.